Okay, welcome to the prepaid and reserves section of this particular slide. Now again, earlier I mentioned an escrow account is a forced savings account held by the lender to ensure that the borrower, you, have enough money to pay any upcoming taxes and property insurance required. So we got two items here. We have prepaid items and reserves, and we're going to break those up. Now be aware that whatever your mortgage payment is when you first get your new loan, it may go up a little bit because your taxes may will have gone up, and or your homeowner's insurance will go up the next year as well. That's pretty common. So this is why you'll see a mortgage company send you a notice saying, hey, you have a shortage in your escrow account. So let's just say your taxes went up $150 and your insurance went up $50 a year. That's $200. So what they'll do is they'll say, hey, do you want to send a check for $200 to bring your escrow account current? And then if so, then your mortgage payment will stay the same as it was the months before. Now, if you say, no, I don't have $200, then they'll automatically just take that $200, they'll divide it by 12, and then they will add that to your monthly statement the next month or two, and then that's your next 12 months payment is the additional $200 over the next 12 months. So that is how that is going to work. So we will now go talk about prepaid items. Okay, prepaid items, as they say, prepaid, so they're paid in advance. Now, if you buy a regular single-family house, you're going to get hazard insurance. Now, that's different than homeowners insurance, because people relate homeowners to the homeowners association. Like in Highlands Ranch, we have an HOA, homeowners association, which is what do we pay? I don't remember now. About $45 a month. We pay it every 3 months. So that's a homeowners association. Of course, the other normal common term, because in the old days you didn't have these HOAs out there. And so with the newer people wanting to move into communities where they're HOA, the term kind of became confusing. But before all the HOAs, it used to be called homeowners insurance, which would be State Farm, Farmers, Allstate. I try to use the term hazard insurance for that particular type of insurance to not be confused with the HOA or homeowners association fees. So prepaids are you pay 1 year up front for your home. So let's just say if my home exact is about what $1,450 a year. So when I buy the house, I have to come up with $1,450 at closing to pay for my policy for the next 12 months. So it's prepaid ahead, just like you do rent for month after month. This is actually year after year. So the prepaid part of it is that 1 year hazard insurance policy. And then another prepay is mortgage interest. Now here's a little bit confusing. When you're a renter, your rent is due on the first of the month, and that allows you to stay in that property for the next 30 days. Now on a house, when you buy a house or even refinance, they want you to be 30 days behind, something that a landlord would never approve of. But in the mortgage world, this is how it works. So let's just say you close at the, let's say you close March 29th. You're going to pay, well, we're going to use 25th. That's my illustration. So what did I say here? I thought I used April. Okay, let's say we close April 25th. So April 25th, you close on that date, and then you have 25, 26, 27, 28, 29, 30. You'll have 6 days in the month of April that you will bring, 6 days of interest on your new house payment that you will bring to closing. You will prepay it so that you are paid up to the 1st of May. Now, when you buy a house or even when you refinance, you do not make the next month's payment. So May 1st, there is no payment. And then in June, that's when your payment is made. And of that payment, the principal and interest of it covers the month before, the month of May. So that is called a prepaid item as well. So now let's just talk about reserves. Okay, reserves. Now, you remember earlier we talked about an escrow account? Well, all the reserves are doing is actually funding the startup of that account. It's like opening up a savings account or checking account. You got to put in $5 or $20, something like this. Well, in the mortgage world, they actually have us do roughly 2 to 3 months of whatever your taxes are and your hazard insurance are. So again, if I use that $1,450 a month hazard insurance illustration, if I divide that by 12, which I'm doing right now on my calculator, that's $120.83 a month. So they may collect, besides the 12 months of it, an extra 2 months or about $241 to put into this new escrow / savings account. And then they'll do the same thing with taxes. So if my property taxes are $200 a year, divide that by 12, that's $183 a month. So they're going to take a couple months of that, which in this case would be about $366. So you're going to see about $500 or so I'm going to need to bring to closing to be the seed money for my escrow reserve account. So again, closing costs are the down payment, are the fees, are those costs, and they're the prepaid and reserves / escrows. So those are what makes up the closing costs on a mortgage loan. So I hope this helps you a little bit in understanding what closing costs and what is made up of closing costs. If you have any questions, feel free to give me a call. Larry at 303-944-2277. I'm the owner of Mortgage Achievers here in the Highlands Ranch, Colorado. My obviously email is Larry at lenderlarry.com. And even if you're out of state, feel free to give me a call or drop me a note. I'd love to answer any questions that you might have. And I wish you the best as you're doing your house hunting and or refinancing investigation. And I'd love to compete and earn your business. So you have a great day.